This presentation is primarily about two subjects: shutdown and liquidation. And the two major questions are, in the short run, should the firm continue to produce or should the firm shut down? And the other question is about the long run. In the long run, should the firm continue to produce or to liquidate? I'm going to try to explain what the shutdown point is. So we're dealing with the short run. And the question is, should our firm shut down or should it continue to produce? Now, if a company shuts down, it still exists. However, it is not producing. Once again, when a company shuts down, it still continues to exist. In other words, it will still be drawing some fixed costs. However, it is not producing. And since it's not producing, it will not be utilizing labor, it will not be utilizing raw materials. So variable costs are going to be zero. So the question is, again, short run oriented question. In the short run, when should a company shut down and when should a company continue to produce? This question will not be asked if a company were to be making profits. This is normally a question associated when a company is incurring a loss. So when a company is incurring losses, when a company is making losses, the question is, when or at what point should we continue to produce in the short run, and when should we shut down? Now, in order for a company to be able to continue to produce, it must draw enough, it must make enough total revenues to pay for all of its variable costs. And variable costs usually are associated with labor costs and paying your suppliers. All right, so that's the idea behind the shutdown point. All right, now if here I am going to reference the beta assignment. The beta assignment, its corrections I've posted on BCOM. So have a look at it. So question 1, how do we graphically identify the shutdown point, and what does it mean? So our firm, the per unit values, that would include all of the per unit costs, that would include the price, that would include marginal cost, etc., etc. All of that is on the y-axis. On the x-axis we have quantity, and here we have the average variable cost curve. So where exactly is the shutdown point? Well, it's the lowest It's the lowest AVC value. So from the table, if we look down the AVC column, we notice that the lowest AVC value is $24.60. So this is how we identify the shutdown point. Another way put, any market price which is above $24.60 would mean that total revenue is greater than variable cost. So our firm would be able to generate enough total revenues to pay for all of its variable costs. Variable costs are labor and, well, paying your suppliers. If, however, the market price is below $24.60, that would mean that variable costs would be greater than total revenues. That would mean that if the company produced, it would not be able to generate enough total revenues to pay for all of its variable costs. And that's just not good. If they're unable to pay labor, and labor would not show up, and if labor does not show up, well, you have an incomplete production facility. So work could not go on in an efficient way. Also, if you don't have enough total revenues to pay all of your variable costs, you will not be able to pay all of your suppliers. So they would stop delivering, and well, again, your production would be incomplete. And the third possibility is the market price equaling $24.60. In that case, total revenues would indeed be able to cover all of the variable costs. Workers would be paid, the suppliers would be paid, and in the short run, the company could exist. Again, remember that when we are dealing with the shutdown point, we're dealing with the short run. The question is always, can the firm continue its existence for the extra day, the extra week, the extra month, the extra quarter, trimester, in the short run? Can they continue to exist? Can they continue to produce? Okay. I have devised for you a numerical example. So here it is. We're told that the market price is $1.50. We're told that average variable cost is $2. We're told that fixed costs are $50,000. And we're told that our company is producing at 10,000 units. And this is not a question whether a company should produce more or less. The company is already producing at its profit maximization, loss minimization point. This is a question as whether our company should shut down or should it continue to produce. So given this situation, price $1.50, average variable cost $2 per unit, fixed costs $50,000, and the fact that our company is already producing at its profit maximization, loss minimization point. Since we're asking the question whether the company should shut down or continue to produce, then we have to conclude that our company is incurring losses. So the question is how to minimize losses in the short term. Not by changing the quantity of production. Already we're doing our best. So the question is, should we shut down or should we continue to produce? So let's compare the scenarios. All right? Let's assume that our firm continues to produce. All right? And here, firm shuts down. Okay, so what if our company continues to produce? Well, if our company continues to produce, then it will incur cost of production, right? So first, it will incur variable cost, right? So how do we get variable cost? Average variable cost times quantity will give us variable cost. So average variable cost is $2. The quantity is 10,000 units. So variable costs are $20,000. Next, if our company continues to produce, it will incur fixed cost of $50,000. All right. So you remember variable cost plus fixed cost is equal to total cost. So total cost is $70,000. Now we turn our attention to the revenue part. So what are total revenues? Well, again, total revenues are equal to price times quantity. The price is $1.50. The quantity is 10,000 units. So total revenues are $15,000. Well, the profit, and here I'm going to use this pi label, this pi designation to mean profit or loss. If pi is positive, then it's a profit. If pi is negative, then it's a loss. So pi, profit or loss, is equal to TR minus TC. Okay, so total costs are $70,000. Total revenues are $15,000. So our company is incurring a loss of $55,000. Okay, now we turn our attention to the shutdown situation. What if our company shuts down? And shutting down does not mean liquidation. Shutting down means the company stops to produce, but it still continues to exist. It has just stopped producing temporarily. The idea is that if a company shuts down and stops producing, that it is thinking about what to do next. In other words, what should we do? How can we improve our situation? Because if we pose the question, should we shut down or continue to produce, we must be incurring losses. So we are in a loss situation when we pose the question, should we continue to produce or to shut down? So what if, under these circumstances, we decide to shut down? So variable costs, if we shut down, are going to be equal to 0. Why are they 0? Well, because we're not producing. We are not utilizing labor. We're not utilizing any factors of production which are variable, right? So variable costs are 0. Fixed costs, well, there we are still paying rent. We're still paying our loans off. We're still paying taxes which are not related to production, etc., etc. So fixed costs, regardless of producing or not producing, and in this case we're not producing, are $50,000. That's a given. Okay, so variable costs 0 plus fixed costs 50,000 is equal to total costs of $50,000. Now we turn our attention to the revenue part. So if we shut down, if we don't produce, total revenues are going to be equal to 0. Not only are we not producing and not selling, we also have to assume that our inventory has been cleared out. In other words, there is nothing in inventory. There's nothing in our stocks, on our shelves that can be sold. All right? So total revenues are 0. So if our company shuts down, well, again, total costs are 50, total revenues are 0. So it'll still be a loss. It'll be a loss of $50,000. Well, okay. You remember the question? Under these circumstances, contained in example 1, should our company continue to produce or should it shut down? Well, if it continues to produce, our company will be incurring losses of $55,000. If our company shuts down, it'll be incurring losses of $50,000. So I think the solution is the company should shut down because it will be able to minimize losses. It'll be able to minimize losses down to $50,000. If it had continued to produce, it would be incurring losses greater than $50,000. It would be incurring losses of $55,000. So the answer is our company should shut down. Again, shutting down does not mean liquidation. Shutting down means you are temporarily not producing, you're still continuing, and you are reevaluating your predicament, your situation. What are we doing wrong? What can we do? Should we cut back on costs? How are we to do this? Should we launch a new product? What should we do? All right. But as it stands, the question is a short-term question. Inside this 1 year, 1 year and a half, which we define as the short term, should we shut down or continue? In our case, we should shut down. We'll be able to minimize losses this way. I have some conclusions about the question, should our firm shut down or should it continue to produce? And the conclusions are based on 3 possibilities. So let's cover them piece by piece. So let's assume that price is greater than average variable cost. Should we shut down or should we continue to produce? Well, if price is greater than average variable cost, this means that total revenues are greater than variable cost. And that implies that we're generating enough total revenues to pay workers, to pay suppliers. In other words, we can pay all of our variable costs. We can sustain ourselves in the short run. We are still incurring losses, but the point is not about profits, losses. The point is about being able to survive in a short run. Surviving the extra day, the extra week, the extra month, the extra quarter, trimester, year and a half. This is how we define the short run. So here the answer is continue to produce. If you continue to produce, you will be able to minimize your losses. Another way put, you're going to be able to survive in the short run. It's a short run oriented question. All right. What if average variable cost is greater than the price? Well, that would mean that variable costs are greater than total revenues. And that would mean that total revenues would not be enough to cover variable costs. Total revenues would not be able to pay for all of the variable costs, meaning the labor cost and paying the suppliers of your company. So you will not be able to pay your workers fully. In other words, some of them would not show up. You would have an incomplete company. It also means that you would not be able to pay all of your suppliers, and they would not deliver the raw materials to you. So you would not be able to have a complete production process. So whenever AVC is greater than P, the conclusion is shut down in the short run. It does not mean liquidation. This is a short run, short-term analysis. And now the third possibility. What if the price is equal to average variable cost? Well, if price is equal to average variable cost, this means that total revenues are equal to variable costs. If total revenues are equal to variable costs, this means that our company is able to produce, it is able to generate enough total revenues to pay all of the variable costs. And it is able to pay fully all of the workers, fully all of the suppliers. So from a shutdown perspective, if price is equal to average variable cost, the company should continue to produce. So these are the three conclusions about the question, should we shut down or should we continue to produce in the short run? Again, keep that in mind. The question about shutting down or continuing is about the short run. A day, a week, a month, a quarter, a trimester, a year and a half perhaps, but nothing more than that. Nothing more than a year and a half, I would say. All right. Our next subject is going to be the question whether in the long run our firm should continue to produce or liquidate. However, before diving fully into liquidation, I think I better explain or try to explain to you the notion of economic profit. More precisely, what I'm going to have to do is explain to you the difference between what you are used to in business school, in accounting profit. So I want to compare accounting profit with economic profit. It's not the same thing, and it is very confusing to students, very confusing. And you're not going to understand liquidation. You're not going to understand what comes beyond this point in microeconomics without understanding the difference between accounting profit and economic profit. Okay, now let's start on the accounting side. What is accounting profit? Well, for those of you who have taken accounting, accounting profit is normally associated by looking at the income statement. That's one of the major financial statements. So what do we have in an income statement? Well, right on top we have revenues. We have total revenues, and then we subtract from total revenues, which can be generated through or by production revenues, sales revenues, whatever. So we subtract from total revenues all the different costs, operational costs, taxes, etc., etc. So at the very end of the income statement, at the very end of this financial statement called the income statement, we have an entry at the very bottom of an income statement. We have the entry called net income. Right? Now, net income is an accounting term, and what it means is, in plain English, it means profit. All right, so net income, that's the accounting term. In everyday language, it means profit. But again, we're dealing with the accounting concept. All right. Now, this net income, this profit. Well, let's take it from a perspective of a corporation. This net income, this profit, who does it belong to? Well, it belongs to the shareholders of the company. So the company, the corporation, can either distribute this profit to its shareholders in the form of dividends, or it can reinvest the money. But let's take the easiest way, and let's assume that the money, this net income, this profit, has been distributed to the owners of the company, the shareholders, in the form of dividends. All right? So that's our assumption. Now, let's assume that accounting profit was $100 million. All right? That's accounting profit. And this accounting profit was distributed to the shareholders of this corporation. All right? So it's gone. Now, the accounting profit is $100 million, which has been distributed to the shareholders of the corporation. But on the books, on the income statement, on the balance sheet, it would read accounting profit, $100 million. Okay, now we turn our attention to my area, which is economics, which is economic profit. So what is economic profit in this situation where net income, profit of $100 million, the accounting profit? So how do microeconomics interpret these $100 million of accounting profit? Well, we would say in microeconomics that the economic profit is equal to, please put your seatbelts on, put your shoulder strap on, we would say that this $100 million of accounting profit as economic profit, it would equal to 0. So we have, so there is 0 economic profit. Well, why 0 economic profit? Well, we assume it's, in economics, we assume that it's 0 economic profit because the accounting profit of $100 million has been distributed, has been given to the shareholders. It's gone. Another way put, in a bizarre way, in economics, we treat the distribution of accounting profits to the shareholders as a cost of production. I better repeat that. In microeconomics, we treat the distribution of accounting profit, in our case $100 million, to the shareholders. This is the distribution in dividend form, $100 million going to the shareholders. We treat that as a cost of production. Economics treats the distribution of profits as a cost. How strange. Not so strange in economic terms. Now, if you're an accountant and if you treat the distribution of accounting profit in the form of dividends as a cost, you will go to jail, because if you're an accountant and you treat accounting profit as a cost, you're basically cheating the government, and that's not good. You will end up in jail. So, what's the assumption in our example here? The assumptions are that our accounting profit was $100 million, and that this accounting profit was distributed, or is potentially distributable, to our shareholders. It's been done. It's gone. So, how does economics treat $100 million worth of profit? It treats it as 0 economic profit. These $100 million have been distributed to shareholders, the owners of the corporation, at the highest possible return on investment. At the highest possible return on investment. So what's left in the minds of economists is 0 economic profit. All right? So this is the difference between accounting profit and economic profit. All right, let's move on to liquidity. That's the next subject. So what is liquidation? Well, liquidation is looking at the situation in the long term, in the long run. Whereas you remember when we talked about the shutdown situation, we were talking about the short run. So if a company shuts down, it is not liquidating. Shutting down and liquidation are not the same thing. In a shutdown situation, a company is not producing, but it still exists. By not producing, a company is incurring fixed costs, but not variable costs. When a company shuts down, variable costs are equal to 0. And in a shutdown situation, what is the company doing? It's thinking, what are we going to do next? All right? What are we going to do next? So they're not sitting on their hands. They're thinking. Now, in liquidation, if a liquidation goes through, then, the company sells its assets off, pays creditors, the government, etc., etc. It's gone. In liquidation, a company has not only ceased to produce, it has ceased to exist. It's gone. Liquidation. So liquidation is about long run. So when does a company liquidate? That's the question. However, our analysis is limited to our first market structure, which is pure competition. Actually, I like the French designation better. Pure and perfect market structure. We'll call it pure competition. Okay? I'll have more to say about pure competition in other videos. Okay, so hopefully you understand what liquidation is, as opposed to what shutting down is. Do not confuse the two. To bring the point home about liquidation, I have put together for you 3 examples. Example 1, where average total cost is going to be greater than price. Example 2, where the opposite occurs, price is greater than average total cost. And then example 3, where the price is equal to average total cost. Now, when we were talking about shutting down or continuing to produce, you remember all that we had to do was to compare price and average variable cost. Price greater than average variable cost. We continue to produce. Price equal to average variable cost. We continue to produce. If average variable cost is greater than price, then we shut down. What I just said is about the question, should we shut down or continue to produce? Now, our present subject is liquidation. So we will be concentrating not on the difference between price and average variable cost, but with price and average total cost. So all we need to do to determine whether we liquidate or continue to produce is price and average total cost. So this is the given, and we have to decide, do we continue to produce or do we liquidate? And again, remember what liquidation is. You sell off your assets, you cease to exist. You're not producing. All right? So let's see. Price, ATC. So we are in essence saying, in essence the question is about profits, but not accounting profit. We're talking about economic profit. So if you have not understood the difference between accounting profit and economic profit, go back to that sequence that differentiated accounting profit from economic profit. So, okay, should our company liquidate, go out of business, or should it continue to, well, produce, to exist? All right? And it's about profit and losses, economic profits, economic losses. Okay, so what do we have here? Well, what we have are total revenues. Price times quantity. So what's the price? $1.50. What's the quantity? 10,000 units. So total revenues are $15,000. What about total costs? Well, there we would have to look at average total cost times quantity. Average total cost is $7. Quantity is 10,000 units. So total cost would be $70,000. So profit, again, total revenues minus total cost, that would give us negative profit. That would give us a loss of $55,000. So obviously, given the negative sign, that's a loss. So the conclusion is you liquidate, because this is not sustainable year after year after year after year. All right? So the answer here is liquidate. So in the long run, whenever average total cost is greater than price, you liquidate. And this is not only applicable to pure competition companies, this is also applicable to the other market structures. In this second example, we have price, which is $10, and we have average total cost, which is $7. Again, the question is, should we liquidate or should we continue to produce? In the long run, the emphasis of this question, should we liquidate or continue, is from the long run perspective, a year and a half and longer. All right, so total revenue, price times quantity. Price is 10, quantities 10,000 units, so total revenues are $100,000. Okay, total cost. Average total cost times quantity. Average total cost is $7 per unit. Quantity is 10,000 units. So we have total cost of $70,000. Profit or loss, that's what the pi sign means again. TR minus TC. So we have $100,000 minus $70,000. So that's $30,000. So that's a profit. That's an economic profit. And that means that we should not liquidate, that we should continue to produce. All right? Now, in this situation, I'm going to switch colors. In this situation where price is greater than average total cost, again from our given, we have a price of $10, which is greater than an average total cost of $7. In this situation, $10 greater than $7, where price is greater than average total cost, this does not apply to pure competition. All right? This cannot apply to a pure competition market structure. It does apply to other markets, pure monopoly, monopolistic competition, oligopolistic behavior, but it does not apply to pure competition. Why not? So what I just said in red does not apply to pure competition. So I'm trying to explain why it does not apply to pure competition. And here's the explanation. In a pure competition market structure, if you have a situation where price is greater than average total cost, this will generate profits which are higher than zero economic profits. And that will bring competitors into the pure competition market structure. And that will lower the price to a level where price is equal to average total cost. Oh boy, I think I better repeat this part. Again, in a pure competition market structure, the situation price greater than average total cost cannot exist, because if in pure competition price is ever greater than average total cost, this would generate profits above normal profits, profits above zero economic profit. And that would attract outside companies. And these new companies entering this pure competition market, this competition amongst the firms, would generate enough competition to bring the price down, to bring the market price down to average total cost. Now, I'm going to repeat this once again, not in this video, but in a video which I've created specifically about pure competition market structure. And also, obviously, you should be reading about this in your books. Example number 3. Again, the question is, should our company liquidate or should it continue to produce? Okay, the price is $5 and average total cost is $5. And of course the quantity is 10,000 units. So from the TR side, price times quantity, $5 times 10,000 units gives us $50,000. Total cost, average total cost times quantity. Average total cost is $5 per unit. Quantity is 10,000 units, so total costs are $50,000. Profit or loss is equal to TR minus TC. So profit is 0. Question: given this profit of 0, should our company continue to produce in the long run, or should it liquidate in the long run? The answer is the company should produce. It should continue to produce in the long run. But why? Because 0 is not a reference to 0 accounting profit. This 0 is a reference to 0 economic profit. And how different is 0 economic profit from 0 accounting profit? 0 economic profit assumes that there was accounting profit and that this accounting profit was distributed to the owners of the company. 0 economic profit assumes that the accounting profit, which was achieved at the highest possible return on investment, was distributed or is distributable. Distributable. It's getting late. Anyway, that this accounting profit was distributed, or potentially it can be distributed to the owners of the company. So 0 economic profit implies that there was accounting profit at the highest possible return on investment. And it is assumed that in the long run, this is the best that companies can do. And this part obviously pertains to the pure competition market structure. So when the price is equal to average total cost, should the company liquidate or should it continue to produce? It should continue to produce. In fact, in the pure competition market structure, this is the best situation. Price is equal to average total cost, because this is a long run position of pure competition firms. This is the best that they can aspire towards. Conclusion summary about liquidation. Again, I've been primarily talking about this pure competition market system. So, in a pure competition market system or structure, if price is equal to average total cost, that means that total revenues are equal to total costs. So should the company continue to produce or should it liquidate? In the long run, the company should continue, because in pure competition, TR equals to TC implies 0 economic profit. And in a pure competition market structure, this is the best possible situation in the long run. Continue to produce. If, on the other hand, average total cost is greater than price, that means that total costs are greater than total revenues. Well, this implies not only uh, not only uh, accounting losses, it also implies subpar economic profits, no economic profits. In other words, below zero. So in this case, in pure competition, as well as other market structures, what should the company do? Liquidation. Okay. All right. In red, the third possibility, price is greater than average total cost. Now, in pure competition, price greater than average total cost cannot exist in the long run. Because if price is greater than average total cost, this would mean total revenues greater than total cost. And if total revenues were greater than total costs, this would imply profits, long-term profits, above zero economic profit. And this just cannot exist because this would imply, given the open nature of pure competition market structures, this would imply competitors from the outside coming in and increasing supply and lowering the price to the ATC level where price would be equal to average total cost. So this situation, price greater than average total cost, cannot exist in the long run, in pure competition, in the pure competition market structure. In other market structures, like pure monopoly, monopolistic competition, and oligopolies, it can exist, of course. And in those cases, pure monopoly, monopolistic competition, and oligopolies, the firm should continue. But again, the emphasis here has been pure competition market structure. So again, price greater than average total cost cannot exist in pure competition. All right, I'm done. Well, I said I was done, but not really. I did it for the shutdown point, but for some reason I did not do it for the liquidation point. What I want to do is I want to identify the liquidation point. So, beautiful diagram, per unit values on the y-axis, on the x-axis quantity, the average total cost curve. Question, where is the liquidation point? It's right there. And you notice that it's the lowest value for average total cost. So reading from your beta homework assignment, your weekly assignment, reading from the average total cost column, the lowest ATC value is $38.75. I want to make sure that's the right answer. Yes, it is. $38.75. All right. So that's the lowest ATC point. that is the liquidation point. Liquidation point. You can also refer to this liquidation point as zero economic profit. And you can also refer to it, let me switch colors, as long run equilibrium. Yes, I am talking about the same point. This point here. It's called the zero economic profit point. It's called the liquidation point, and it is also called the long run equilibrium. And one more thing, it is at this point where marginal revenue is equal to marginal cost, is equal to price, is equal to average total cost, is equal to demand. Did I leave anything out? I don't think so. Price, marginal revenue, marginal cost, demand. And all of this is going to be explained to you in the video about the pure competition market structure. Okay, so I'm going to post an assignment for you. Assignment gamma, third letter of the Greek alphabet.